For most of the 20th century, Iceland's banks were state-owned institutions serving a modest domestic economy built around fish exports and aluminum smelting. That changed when the government privatized the sector. Kaupthing Landsbanki and Glitnir were sold off between 2002 and 2003. The buyers were well-connected Icelandic businessmen with international ambitions, and from the day the transfers were complete, the new owners began looking far beyond the North Atlantic for growth. Iceland's Special Investigation Commission, which released a comprehensive report in April 2010, found that the privatization process was conducted without regulatory frameworks adequate to contain the scale of expansion that followed. The timing aligned almost perfectly with a global lending environment that rewarded aggression. Interest rates in the early 2000s were low, wholesale credit was abundant, and international investors were searching for yield. Iceland's newly private banks discovered they could borrow cheaply on European interbank and bond markets and redeploy those funds into acquisitions across the continent. Between 2003 and 2007, the three banks expanded into the United Kingdom, Denmark, Luxembourg, and other markets, buying brokerages, retail banking operations, and investment firms. Iceland's central bank documented in subsequent reports that the combined asset base of the three institutions grew at a pace that had no historical precedent in the country's financial record. To fund continued expansion, Landsbanki designed a product called Icesave, an online savings account launched in the United Kingdom in May 2006 and extended to the Netherlands in 2008. Icesave offered interest rates above anything the major UK and Dutch high street banks were paying, and retail depositors responded at scale. By the time Landsbanki collapsed, according to figures cited in subsequent parliamentary proceedings and court records, the Icesave accounts held approximately £4.5 billion from about 340,000 UK customers and roughly €1.7 billion from about 125,000 Dutch customers. Crucially, these accounts were not branches subject to UK or Dutch deposit protection in the normal sense. They were branches of an Icelandic bank, covered in theory by Iceland's own deposit guarantee scheme, which had nowhere near the resources to make good on that scale of obligation. By the end of 2007, according to the Special Investigation Commission's 2010 report, the combined assets of the three banks had reached approximately 923% of Iceland's gross domestic product. Put plainly, the liabilities these banks had accumulated were nearly 9 times what the entire Icelandic economy produced in a year. Iceland's central government budget and foreign exchange reserves were a fraction of that figure. If any one of these banks required the kind of backstop that the United States provided its largest institutions or Ireland provided its banks, the Icelandic state could not have supplied it. The banks had grown past the point where their home government could plausibly stand behind them. Lehman Brothers filed for bankruptcy protection on September 15, 2008. Within hours, the short-term borrowing markets that Iceland's banks depended on to continuously roll over their debts effectively seized. Counterparties across Europe stopped extending credit to institutions they assessed as risky, and the Icelandic banks were near the top of every risk list. Confidence in the system had been eroding through much of 2008 as analysts published assessments noting the mismatch between what the banks owed and what stood behind them. After Lehman, the window for rolling over existing borrowings closed almost entirely, and the banks had no realistic path to replacing that funding from domestic sources. In late September 2008, Glitnir's management approached Iceland's central bank for emergency liquidity. The central bank could not meet the need, and on September 29, the government announced it would acquire a 75% stake in the bank. Parliament moved on October 6 with emergency legislation granting the Financial Supervisory Authority broad powers over the entire banking sector. The authority used those powers immediately. Landsbanki was placed in receivership on October 7th and Kaupthing on October 9th. In the 12 days between the Glitnir announcement and the fall of Kaupthing, every major commercial bank in Iceland had been nationalized or placed in receivership. The old banking system, built over a decade of aggressive expansion, no longer existed. As Landsbanki collapsed, the UK government faced an immediate problem. Billions of pounds of British depositors' money had entered an Icelandic receivership, and it was unclear whether Iceland's deposit guarantee scheme had any realistic capacity to cover the losses. On October 8, 2008, the British Treasury invoked the Anti-Terrorism, Crime and Security Act of 2001 to freeze the UK assets of Landsbanki and 2 related Icelandic institutions. The use of anti-terrorism legislation against Iceland, a NATO member and an EU-associated state, caused an immediate and lasting diplomatic rupture. Icelandic officials and the public reacted with sharp anger. The UK government defended the action as the only available legal mechanism to prevent assets from being transferred out of British jurisdiction before insolvency proceedings could protect depositors. Iceland's currency, the krona, lost roughly half its value against the euro in the weeks following the bank collapses, according to data compiled by Iceland's central bank. With foreign exchange reserves inadequate to stabilize the currency and the domestic banking system unable to function, Iceland applied to the International Monetary Fund for emergency support. In November 2008, the IMF approved a 2-year standby arrangement of approximately $2.1 billion. The first such program extended to a developed country since the United Kingdom sought IMF assistance in 1976. The program required Iceland to impose capital controls restricting the movement of money in and out of the country, which the government enacted almost immediately. Those controls remained in place in various forms for nearly a decade. The central political dispute after the collapse was who would repay the Icesave depositors. The UK and the Netherlands had compensated their own citizens from national schemes and then sought reimbursement from Iceland, which, as the home country supervisor, bore the primary obligation under EU deposit guarantee rules. The Icelandic parliament passed repayment agreements twice, and twice Iceland's president declined to sign and instead called a national referendum. In March 2010, voters rejected the repayment terms by 93%. In April 2011, a revised agreement was also rejected by 60%. The dispute was ultimately resolved in Iceland's favor. The EFTA court ruled in January 2013 that Iceland had not violated EU directives by failing to guarantee the deposits beyond the minimums its own scheme was designed to cover. Iceland's response to the crisis differed sharply from the approaches taken by the United States, the United Kingdom, and Ireland, all of which used public funds to limit losses for large bank creditors. Iceland's government protected domestic depositors by transferring their accounts into new state-backed successor banks, but it allowed the old bank's foreign creditors and bondholders to absorb losses through the receivership process. Some economists, including those at the IMF who later reviewed the recovery period, have argued that this approach contributed to Iceland's faster than expected return to growth by preventing private bank debts from becoming sovereign obligations. Others caution that Iceland's small size, its control over a floating currency, and the specific structure of its debt make it a difficult case to generalize from, and the debate over what lessons it holds for larger economies remains genuinely unresolved. Iceland took a step almost no other country took after the 2008 financial crisis. It pursued criminal prosecutions of bank executives. A special prosecutor's office investigated and charged dozens of individuals, and senior executives from the failed banks received prison sentences through the Icelandic courts. Reidar Mar Sigurdsson, the former chief executive of Kaupthing, received a sentence of 5.5 years, according to Icelandic court records. Several other senior figures at all three banks were also convicted. Iceland's GDP contracted sharply in 2009 and 2010 but returned to positive growth in 2011, and the unemployment rate fell steadily from 2011 onward. The capital controls imposed in 2008 were finally lifted in stages between 2015 and 2017. The Iceland crisis illustrated a principle that deposit protection rules had always assumed in theory but rarely had to confront in practice. A government guarantee is only as credible as the fiscal capacity behind it, and if the banks the government supervises have grown far beyond what that government can realistically backstop, the guarantee is functionally hollow. Most developed countries today apply deposit insurance caps partly for this reason. Unlimited guarantees would require unlimited government capacity to honor them. The crisis also demonstrated that a bank's asset to GDP ratio relative to its home country is a structural warning sign distinct from the health of any individual balance sheet. Whether Iceland's approach of protecting domestic depositors while letting foreign creditors take losses is a transferable model or a product of very specific circumstances is a question economists continue to disagree on, and no definitive answer should be treated as settled.